So this is a short video to explain what short selling is with respect to stocks and ETFs and other securities. Just a word of caution, short selling is extremely risky and you can actually lose a lot more money than you actually have. So when you buy a stock, for instance, when the stock goes bust, you could actually lose all your money. But when you sell a stock or an ETF short, you could lose more money than you have. So short selling is very risky. So I like to actually start with an example and go through the process. And I chose S&P 500 ETF for this example, just for the lecture purposes and nothing else. And just keep in mind that everything that we talk is all for educational purposes. So at the beginning of the year, January the 3rd of 2022, I said that trader has money in his or her brokerage account. For the short selling, you actually need to have money in your account so that the brokerage company would know that you would have some collateral in case you incur losses above and beyond the actual sale that you do. And so you need to actually have money in your account. So notice how at the beginning of the year, S&P 500 actually went up to its highest in I think, all-time high, and the level was about 475. And SPY is an ETF for the S&P 500. So on January 3rd, we noticed that this is actually a very high level. And I had an example that says that the trader believes that S&P 500 price is too high and it may actually decline soon. That's our expectation. So on January the 3rd, the same day, we actually do a short sell. Notice I included a screenshot from a brokerage account. You can actually choose the sell short, and you could include the quantity and the symbol. And for this example, historic, I basically spelled out what is being done in the background. So when you sell short, you're actually borrowing shares of SPY for this example, and from the brokerage company, and then you're selling these borrowed shares in the market. So the trader borrows one share of SPY for this example, and we're borrowing this from our own brokerage company, and then we're selling these borrowed shares in the market at 475, and that is the price that we thought was high. And at that point, we actually believed that the market could turn and go down. And obviously, we could be wrong, and in which case we would lose money. So just to summarize, on January the 3rd, we thought the market was too high, and we thought it was going to come down, and therefore we decided to short sell SPY, which is an ETF for the entire S&P 500 market. So as of January the 3rd, we now have $475 in cash in our brokerage account, which we cannot touch. You cannot withdraw that money out. And it will actually stay in the account as a collateral for the shares that we just borrowed. And we owe one share of SPY as we actually borrowed this from the brokerage company. So what we owe is the shares, and we now have cash instead. So for the year going forward, we will simply wait for S&P 500 price to go down. And during this time, we owe the shares to the brokerage company, and therefore we pay interest on these borrowed S&P 500 shares. So when everything's said and done, we must return one single share of SPY because we borrowed one single share of SPY. So whatever you borrowed, you have to return. You must return the shares. So if you borrowed 100 shares, you have to return 100 shares. Since we sold the borrowed SPY, the price of SPY can increase to $1,000 or even more. And I just chose these numbers arbitrarily. And S&P price can decrease to 200 or less. And like I said, I chose this arbitrarily. So we could actually make money, or we could lose substantial amount. But the bottom line is we must return the shares that we borrowed. We cannot turn the clock back and say, well, we sold the shares at 475 and we want to return. No, we have to return the actual shares that we borrowed. So again, we must return 1 share of SPY regardless of the price. And since for this example, we borrowed 1 share of SPY, that's what we must return. And to return them, we must buy them back regardless of the price. So if SPY increases, then we're going to have a loss, because then we have to buy back SPY higher than we sold it, and therefore we will have a loss. And if the SPY price decreases, then we will have a profit. So on October the 10th, notice how the S&P 500 actually declines as expected. But obviously for this lecture, 2020 hindsight, it was very easy because I already knew what was happening. But if you could predicted this, yeah, then having the short sell would be very profitable. And notice we actually sold it on January the 3rd at 475. Now on that October the 10th, the price is actually 350. So the SPY price declines. And what we need to do now is we need to buy the shares back and return them to our brokerage company. So I included a screenshot of our brokerage account where it says buy to cover. So we're going to buy to cover our short, and we'll buy it at the market price. I just made it up at 350, and then we will return the shares to SPY, which again, I'm spelling this out, but you simply choosing buy to cover buys the shares and returns them back to the brokerage company. So to summarize, January 3rd, we sold SPY short at 475. And October the 10th, we bought them back at 350. So we had a profit of about $125 minus the interest that we paid while we were waiting for the market to go down. So we sold it at 475. We bought it back at 350. The difference is our profit, which is 125. Although it could have been different. The SPY could have continued its increase, and it could go up to $1,000 that I just made it up arbitrarily or more. And in which case, $1,000 would be the price that you have to buy it back or more, minus the 475 that we actually sold it short, which means that for this example, where the S&P 500 goes to $1,000, we lose $525 plus the interest that we paid while we were waiting for the price to go down. So notice how you could actually end up losing substantially more than you thought you would actually make. When you're shorting a stock, the idea always is that, so for the S&P 500, for instance, the SPY, the price that we sold is 475. The worst that can happen for that stock is it goes to zero, in which case you would realize a $475 profit. But the best that can happen to that stock is it can actually go to 1,000, 5,000, 10,000, which means as a short position, you have to still buy it back at this new and high price, in which case you would have a substantial amount of loss, which could be above and beyond whatever money that you have. And notice, by the way, that most people believe that stop loss orders and orders as such can protect you, but they cannot, because they actually kick in when the markets are open. But sometimes things happen overnight, and by the time you wake up in the morning, you'll see that the price has jumped, and that jump could be the end of your financial standing as you know it. So going back all the way back to the initial slide, the risk is quite real, and that you need to understand that going short is very risky, and you can lose substantially more money than you actually have. So thank you. Bye now.